Hey there, future billionaire. Welcome to another investing video. Today, we're going to dive into the world of investing and help you decide whether you should invest in stocks, bonds, or a mix of both. So grab a seat, get comfy, and let's unlock the secrets of building wealth together. Make sure you watch the whole video because we've got some great tips and surprises coming up. But first, let's tackle the basics. What exactly are stocks and bonds? Picture stocks as tiny pieces of a company. When you buy a stock, you're actually buying a small slice of that company, making you a shareholder. As the company grows and does well, so does the value of your stock. Bonds, on the other hand, are like IOUs. When you buy a bond, you're lending money to a company or government. In return, they'll pay you interest over time and eventually give you back your initial investment. It's like a long-term loan with perks. So, which one should you choose? Stocks, bonds, or a mix of both? Well, there's no one-size-fits-all answer, but don't worry. We've got the tools to help you make that decision. The key is to find the right balance for you. It's all about your risk tolerance and investment goals. Stocks have the potential for higher returns, but they also come with more risk. One day you might be riding high, and the next, you could be down in the dumps. Bonds, on the other hand, are generally considered safer investments. They offer more stable returns, but usually at a lower rate. Slow and steady wins the race, right? But wait, there's more. Your age, financial goals, and time horizon also play a huge role in deciding how to invest. As a general rule, younger investors with a longer time horizon might lean more towards stocks for their growth potential, while those nearing retirement might choose bonds for their stability. It's all about finding the perfect mix that suits your unique situation. It's crucial to understand this concept to make sure you're investing in a way that best suits your needs and avoids any unpleasant surprises during retirement. Picture your investment journey like climbing a mountain. When you're young and just starting out, you have plenty of time and energy to take on more risk. Your longer time horizon allows you to ride out the ups and downs of the stock market, giving you the chance to potentially achieve higher returns in the long run. Remember, stocks can be volatile, but they also offer the potential for substantial growth over time. Now, imagine you're nearing retirement. You're closer to your destination and have less time to recover from any potential market downturns. You might prefer to take a more stable path and focus on bonds, which generally offer lower but more predictable returns. In this phase of life, preserving your wealth and generating steady income become the top priorities. You definitely don't want to be in a situation where you need money for retirement, but your stocks are down. This can happen during market downturns, and it's not the time to be forced to sell your stocks at a loss. That's where bonds come in handy. They can provide a cushion of stability and income, even when the stock market is volatile. So, how do you make the transition from a stock-heavy portfolio to one that includes more bonds? One popular strategy is to gradually shift the balance of your investments as you get older. This can be done by periodically rebalancing your portfolio to maintain a target allocation of stocks and bonds that reflects your changing risk tolerance and financial goals. Another option to consider is target date funds, which automatically adjust your investment mix based on your planned retirement date. These funds start with a higher allocation to stocks when you're young and gradually shift towards bonds as you approach retirement. They're a convenient, hands-off way to manage your investments over time. And now, for the magic word, diversification. Mixing stocks and bonds in your investment portfolio helps you spread out the risk, so you're not putting all your eggs in one basket. Let's dive deeper into diversification and explore the fascinating world of correlation between stocks and bonds. Understanding how these two investment types are related can help you make even better decisions for your portfolio. So, buckle up and get ready for an exciting ride. First off, what is correlation? In the world of finance, correlation measures how different investments move in relation to one another. A positive correlation means that they move in the same direction, while a negative correlation means they move in opposite directions. A correlation of 0 indicates that there's no clear relationship between the two investments. The correlation is usually measured on a scale of -1 to 1, with -1 being perfectly negatively correlated, 1 being perfectly positively correlated, and 0 meaning no correlation. When it comes to stocks and bonds, their correlation can vary depending on market conditions, economic factors, and investor sentiment. Historically, stocks and bonds have had a low or slightly negative correlation, meaning they don't move in the same direction most of the time. This is great news for diversification. But remember, correlation isn't set in stone. During certain periods, stocks and bonds may become more positively correlated, meaning they move in the same direction. This can happen during major economic events or when investors flock to safer investments like bonds in times of uncertainty. So, what causes these fluctuations in correlation? Several factors can influence the relationship between stocks and bonds, including 1. Interest rates. When interest rates rise, bond prices tend to fall, while stocks may react differently depending on the state of the economy and corporate earnings. 2. Inflation. Higher inflation can negatively impact both stock and bond prices, while lower inflation can have the opposite effect. 3. Global events. Political turmoil, natural disasters, or pandemics can cause shifts in the correlation between stocks and bonds as investors adjust their strategies to adapt to changing conditions. The bottom line? It's essential to keep a close eye on the correlation between stocks and bonds in your portfolio. By understanding the factors that drive these correlations, you can better adapt your investment strategy to maintain a well-diversified portfolio that meets your goals and risk tolerance. So there you have it, folks. Diversification, correlation, and the relationship between stocks and bonds. Essential knowledge to help you make informed decisions and build a rock-solid investment portfolio. If you found this information helpful, please give us a thumbs up, subscribe, and share this video with your friends. What is your portfolio strategy? Let's have a discussion in the comments down below. Remember, this video is for educational purposes and does not serve as financial advice. Unfortunately, I'm just a YouTuber and no financial advisor. Don't miss out on more fantastic financial tips coming your way. Until next time.